Hello, welcome here to the channel, The Paper Bag Investor. I wanted to walk through a little bit more detail from the Q4 2021 earnings call for Lemonade and just try and give more perspective on, is this company a company that's sort of dead and going to die, or is the probability still the same or even better or similar that they still could succeed? So try and answer those questions and just give a little more depth now that we had the call. My last video was we had the earnings report, but the call had not happened yet. So I'll just run through a few highlights and things I thought I should point out. Let's jump into it. So first was a say question that I proposed around profitability. And here's the answer we got. Or here's my question. I said, how can Lemonade sustain rapid growth and cash burn for many years? How? And approximately when do you see the switch to profitability happening? And Daniel's answer here, he said, basically said, they've raised about 1.5 billion over the whole life of the company, and they have still 1.1 billion in the bank. So you think about all the money they've raised, they still have a significant amount. The stakes are higher now than ever because the amount of losses they have every quarter continues to grow. So that obviously can't continue forever. And he talks about Metromile here, brings in some added in-force premium and some cash with that deal as well. This was interesting. He said, I think we have access to more cash were we to need it. So that is really encouraging. If he feels if in 3 years from now their losses, maybe they grow, or maybe they plateau but they don't shrink and they continue to lose money, they could access more money if they were to need it. Hopefully they do not need it. That would be the major hope, but he feels they still could. And then he sort of goes on to what the earlier comments from the letter and the call about that they've really done a lot of the heavy lifting and building out of their products. Really, they have so far. And the biggest addressable market products, and now they're just trying to push out and grow with those products. So this is encouraging. Again, he touched on this. He thinks for me, it's encouraging. They're probably 6 to 9 months away from our peak losses, and we expect to see our losses decline with every successive year after that. So again, this was he said this in their letter. They thought 2022 would be the year of peak losses, which you could take as there might be still some good buying opportunities over the next 2-3 quarters. If this is true, might even hard to say what the overall market's going to do. It's hard to predict that, but even how people react, I think, could still react negatively to Lemonade if their losses continue to grow. Could even get sort of more hairy or worse, and you might have some great buying opportunities in 6 to 9 months or in the course of this year, maybe later on in this year. Could be some great opportunities, but again, I'm actually very encouraged by that they're sort of suggesting there's light at the end of the tunnel, and after this year, things should start to get better. Okay, so we'll move on here. Next question, the car rollout. So I asked, once Metromile closes, the acquisition closes, how will the rollout occur? Do you expect to immediately offer Lemonade in every state possible? Do you plan to roll it out more conservatively and slowly? Why? So trying to get a little more insight into what they're thinking. And he talks about that they think it will close in the second quarter. Not sure when. He doesn't really give a super clear answer. Not sure when we'll hit 49 or all 50 states, 51 states. I think what people were confused. Someone else was asking 49 states because I thought, if I understood right, Metromile is licensed in 49 states. Maybe that's not the case, or maybe you're misunderstanding something. But either way, all of across the U.S. It says we're about a year away from being able to offer Lemonade Card to the majority of Lemonade customers. And then we'll continue to expand rapidly after that as we'll prepare to people who are not yet Lemonade customers. So Lemonade's not in every single state already with every single product, so they're obviously not going to rush out Lemonade Card every state, everywhere, and try to offer and service to every single customer. I mean, the thing about being an insurance company is that every single customer you take on is a potential future liability. So you can only grow so fast just by your own regulatory reasons. There's requirements around how much cash you need to hold versus how much premium you're writing. So there's limitations there already, but also you want to be careful, because if you roll out a product too aggressively, you could really shoot yourself in the foot. Maybe if your underwriting isn't fine-tuned enough, or you're offering prices, you're offering insurance too cheap for what the risk you're really taking on. And so that's a dangerous spot if that was to happen. So and he talks about this here. He says, we absolutely will monitor our performance in terms of customer acquisition costs and lifetime value as we charge the rollout. So doesn't give super clear context, but he does say we remain pretty bullish on our ability to roll out reasonably quickly over the course of the next 12 to 18 months or so. So it seems like it's going to be a pretty aggressive ramp up, but it's not going to be like a massive, huge step change where suddenly they're have way more premium on the books, but it seems like they're going to aggressively crank it up with what they feel is comfortable within that sort of amount of growth, amount of risk you're taking, sort of potential future liabilities as your customers. You could call your customers that. So interesting answer there. Okay, and then another one was someone else's question about, and he it wasn't about loss ratios, but they touched on loss ratios. This guy named Darren said, is there a quantifiable way you can prove your technology advantage, since loss ratios are still negatively impacted by scaling on new products and operating expenses is still in rapid growth mode? And his was a long kind of answer, but I just took one snippet about the loss ratios. And he said, I can reiterate some of the things that we've disclosed in the past. For example, you saw our renters business for the first few years of the company's life. Renters was an overwhelming dominant part of our business. We did have homeowners, but over 90% of our customers were rented. And you saw that loss ratio trajectory drop from 300% down to, as we're reporting, 59% at the time of our IPO. So massive, crazy drop. So you saw record drops in loss ratios, the likes of which traditional insurance companies have not delivered in the past. So this is a standout case I've seen, just to use the data feedback loop. Using the data feedback loop to very, very rapidly bring down loss ratios. And actually, I mean, I just bring this up. He talks about renters, dropping dramatically in loss ratios when it was the main part of the business. And I would love it to see, and I think some point as the company matures more, and especially if they're successful, I could see them doing this, because but I would love to see them break down each product line a little more carefully. So actually show the premium in each product line and the gross earned premium in each product line, loss ratio in each product line. So you can actually see something more mature like renters. How much is renters really growing? What's the loss ratio like? Is it still at 60% or something for renters, like something really, really good? And then you can see other newer products like your car insurance. As they roll that out, it might have a really high loss ratio, and then they can fine tune that over time. And homeowners, pet insurance, and see, are they making improvements in those specific products or not? It would be really awesome to see that as investors. I hope they can do that sooner than later, because I think it would give a lot of confidence to investors and just give a lot of transparency. But we'll see. I hope they could do that, and I think eventually they would, but I hope they do it soon. Okay, guidance. We'll talk about their guidance a little bit, and there was some analyst questions on this. And I'm not going to read all of this here. You feel free to pause it and read it if you want, or listen to the call. But he's kind of asking about, can you elaborate a little bit on why we would see some slowdown here for guidance? Because he's talking about, is it more on the customer side, premium per customer side, and why is that, or why that is? And so Daniel, he's basically, because if you look at their guidance numbers, they are quite a bit lower than you'd expect. And we're going to just pop open a spreadsheet here quick just to kind of show that a little more clearly. And again, I'm not going to read all of his answer here, but he talks about this year having a growth of around 78%. But actually, they're guiding, they don't show this in their guidance, but they are expecting to have about 70% year growth on the guidance from this year to next year. So with Metromile acquisition included. So he does say, we do intend to keep this pace of growth, and 2022 will be similar in terms of top line growth, but that's not exactly what their guidance says. So I think it's quite confusing to the market and maybe to some investors. Let's see what Daniel means here. Just hop over here. So if you look at kind of their top line growth numbers, customers, premium per customer, in-force premium total over every quarter, and then you have some year-over-year growth metrics for in-force premium and for customer growth. You can see, one comment too is that this quarter actually was pretty bad for customers. Growth was only 63,000. But if you look at year-over-year numbers, not bad, 43%, 45%, was the last quarter. So really not a huge change. You can also see, it seems like the Q4 tends to be a little smaller, like Q3 in the fall is their bigger push for more people move then, more people go to school and maybe need a renter's policy. So you have more customers added. The same thing happened here, Q3, and then Q4 was quite a bit smaller. So that kind of trend happened again, which could, kind of explain some of that there. But then this red kind of section here is projecting out into the future. And if you just based on their projections, they're saying about 405 million next quarter of in-force premium, and for the end of the year, 535. And you kind of just pick some numbers in between for the middle. Maybe they have 25, 50, 55 million as CAR rolls out later this year, gets expanded further. Like their year-over-year in-force premium, they're suggesting is going to drop from, it's been 80, 90%. Down to, it's going to drop into to the 40% range. A massive decline. Very, very concerning if you're just looking at that. And either you have to sort of assume the premium per customers, if it's growing this amount, then also then correspondingly, if you work backwards from that, your customer growth also means it's gone from kind of 50% range, 40-something% range, all the way down to we're talking 20% or less year-over-year growth. So definitely would be very concerning if this is a scenario. And this is what their if you look at their graph of what their guidance says, this is exactly what these numbers say. So I think the market takes that very negatively, and makes sense they do. But if you include the Metromile acquisition, which they say with that they expect they're going to have 70% growth. So we flip over here, and you just take 70% of the 380 that they're at now, you're going to get 646 million. And now it's a totally different story. I mean, you're still at that 70% growth range for the year. By the end of the year, your customer growth could be growing at, depends what your premium per customer is as well, and how many customers. So these could be even higher, or could be higher or lower, but they could easily be at 1.8 million customers and still growing at 30 some percent, maybe high 20% per year. It's just a totally different story to be growing at 70% here or growing at 40% here. But really, I think how they're thinking about this, and from Daniel's answer, they're kind of thinking about the Metromile acquisition as part of their organic growth. So the premium they're immediately taking sort of as a step change from that is part of the risk that they're willing to take for this year. Like I said earlier, insurance is a weird business because every customer you're bringing in is also a potential future liability. They all carry a little bit of risk that could pan out, nothing could happen. They collect their premium and it's all great, or you might owe them a payout, and you might owe them a large payout. So you have to be careful. I mean, how quickly you grow. So I'm assuming just the amount of risk they're factoring in the amount they're planning to grow into with the amount they're gaining from Metro Mile, and then still kind of keeping it at that, something around the 70% year over year growth. Okay, and then Tim also had a comment on long-term growth I wanted to mention. He said, I would also add that is that in terms of our addressable market and our view of long-term growth, we've never been more bullish. I think with renters, I think it's fair to say their market share, particularly in news to the market, has gone from zero to fairly significant over the past few years. But when you layer on home, pet, car, and life and beyond, those are extremely large markets, many multiples of the size of the ventures market. We're just sort of scratching the surface on those, and so our growth rate is something we're quite focused on with balanced growth, optimized growth, integrating Metro Mile, getting car moving out. Those are almost equally important as well as what the overall growth rate is. And the TAM is something that is we think it's important to keep our eye on. So as he says they've never been more bullish on their long-term growth. And if you take these comments at face value, then I mean, it's more conceivable to me that they could grow 70% for the next few years as these bigger products roll out. That concludes this little video here. Again, trying to answer, is this company, how do I think, is it more or less probable that they will succeed? In my mind, nothing, the probability really hasn't changed, even though the stock's just been hammered. To me, we really won't know until later this year and early next year. We'll have much clearer signs of how the car rollout is going, how that's being received. And it will be even better too if maybe they listen to this video and they split up, to disclose more information to investors about the loss ratio on a product by product basis, and even how on a product by product basis how each product is doing. I think would give investors a lot more clarity, just show a lot more transparency from management, and give investors a lot of trust and confidence in that if we could see those numbers. So hopefully we see that, then we could really track the story as it progresses. But in my mind, again, probability really hasn't changed as much as the stock's valuation would suggest, and so I'm continuing to hold. And as I mentioned in my last video, I might still be adding shares conservatively. It's sort of been my strategy all along. Not a huge part of my portfolio at this point, but hoping the stock does really well and could become a large part. So, okay, thank you so much for watching. If you have any comments, let me know in the comments down below. I read all your comments. I appreciate your feedback. You can also find me on Twitter at PaperBagInvest. And remember, it's in the bag.